Thank you all very much for the opportunity to be here today. I know it's been a long day, and I'm going to just make a few points in my testimony. First, I want to say thanks to Speaker Craddock, Representative Rodriguez, Representative Reeves, and Representative Johnson for filing this bill. And Madam Chair, I'd also like to thank you very much for filing your bills. And as you're aware, I'm working hard on those as well.
And I appreciate that.
And hopefully we'll have a good outcome there. But I wanted to start off today talking primarily about why we decided to support this strategy under 410 and the similar bills. And start off by saying again that we don't seek to put these folks out of business. They provide a service to those in need and deserve to be compensated. And we understand there's a great risk with these loans and that the rates will be higher than others. But precisely because the borrowers are so often in a financial crisis, it's all the more important that there are clear rules that define that product. We should have a system that rewards lender and borrower success. We don't see any problem when a borrower gets a loan, pays it back, and the lender makes a handsome profit. But when a customer can't pay, they should not be placed in a position of paying fees that never reduce what they owe. And you've heard plenty of stories about that today.
I'm sorry to interrupt you.
Yes, ma'am.
When I called you up and you started your testimony, did you state your name?
I did not. It's Stephen Reeves, and I serve as Legislative Counsel for the Christian Life Commission,
Thank you.
The Baptist General Convention of Texas. So I want to address the idea that these bills put all of these lenders out of business. As I said, that's not something we want to do, so we had to evaluate these bills and we decided to support them. And I understand that after these bills pass, they're currently operating as CSOs. They would no longer be able to operate as CSOs after this bill passes. However, knowing what Commissioner Pettyjohn said earlier, that there are 1,700 small dollar lenders registered under 342, subchapters E and F, that are making 2.4 million loans at about $4.3 billion a year, that sounded like there's some people doing it, making a profit and surviving just fine under 342. Secondly, when you look at the rates, and I know Representative Farias touched on this earlier, that are set out in 342, that take into account the high-risk nature of these loans and the need to make a profit, for a $100 14-day loan, the APR is 309.47% under Chapter 342. For a $300 two-week loan, as was stated earlier, the APR is 135.57%. We felt that that was a generous rate that should take into account the risk and still provide enough for overhead and business expenses. Now, we've heard it claimed that that's not the case, and we are working to try and find a tenable position for them as well, so as not to put them out of business. But in coming into this session, when we saw how many were doing it profitably and what the rates were, we figured that shouldn't put them out of business. We have seen them put out of business in other states. This is correct. Some states ban the practice altogether. Not a rate cap, just ban it. In Wisconsin, for example, they just ban auto title lending. Can't do it. In Florida, is, when it comes to car title lending, is one of those rate cap states. That Governor Jeb Bush signed a 30% APR rate cap on auto title lending. And as was mentioned earlier, we see places like Arizona, Montana, pretty conservative states, when it gets to the voters, pass a 36% rate cap. That was not our strategy. We did not go for that. We were not trying to put them out of business. So we got behind this effort to just close the loophole and put them under the lending laws as they are. Just wanted to explain to you how we came to that position. Yes.
Representative Wall.
I just want to thank you for your thoughtful consideration and all the work you've done on trying to put all this together.
Thank you, sir.
Because, you know, we've had a lot of testimony today and talking about interest rates at 500% and 400% rates and all that. But the reality is we have all the major banks charging those rates today. If you go and you I've had my kid write a check for Sonic for $12 and get a $35 penalty, and it's about 700% when you look at the check, a bounced check. If you go to an ATM and you pull out $25 and they charge you $2 or $3, it's about 300% on that. If you look at hot checks, I mean, you're looking at a $35 check charge. I mean, we have on both sides.
The bank and
I had a little niece, and the bank charges and stuff. So we have that going. I mean, we have going on in everyday practice 300% if somebody writes a hot check today. And so trying to get to what is workable on a situation, and I think this committee is looking very strongly at regulation and trying.
Sure.
So I just want to thank you, but I think it does need to be said that when you just look at a percentage rate and throw out, 400% is just crazy. It's happening every day of the week right here in Austin, Texas, and around the state of Texas on bounce checks, and if you overdraw your account.
Can I respond to that in a few ways?
Absolutely.
First of all, as we've heard before, if you default on this loan, you're going to suffer that same thing. They're going to put your check. So these actually cause more insufficient fund charges. So the argument doesn't really make a lot of sense in some ways to me. However, those are one-time charges when you do that. Now, if you stay over balance, they're going to hit you again and that sort of thing. But we've already heard that federally they are looking into those practices very closely and want to change it because those are unfair. But also it does depend on the amount. If you bounce a $500 check and it's a $25 fee, that's a different APR than a $17 Sonic with a $25 fee. So it's, again, apples to oranges type comparison in my opinion.
Maybe so.
So
when people get desperate, they write those hot checks.
That's true.
And if they're having to feed their kid, it's not a $500 check. It is a $34, $35, $40 check, and then it's almost 1,000%. I mean,
sure. I mean, I totally understand your point. I just think there are different situations, primarily because the Federal Truth in Lending Act says this is how you calculate what a loan costs.
Right.
It's not the same calculation for a fee on that type of situation. So I want to address demand, and Pastor Ogletree hit on this earlier, so I'll be quick. But as we said, there is a demand for these loans, in the communities. However, I think it is overstated. Let's talk about the example from Midland, where the lady had to borrow this huge chunk of money to bury her son-in-law, I think it was. So she goes out and gets an auto title loan. That's one loan. She can't keep it up, so what does she do? She goes and gets 8 loans. And then if she can't pay on those, she has to just pay the fee. Well, many times that's not just a fee, that's technically a new loan. So now we have one emergency situation with one original loan, and now we've got 10, 12, 15, 20 loans. That sounds like a huge demand, when in fact it was one situation and one loan that caused all of those loans. So I want to make sure we put that into perspective. Third point, we heard about them being brokers. Obviously under the CSO, that's the type of situation we're in. They're not brokers in every other state. They are lenders. They're regulated as lenders, and they act as lenders. The third-party relationship is not always there everywhere. And finally, to end my testimony, I want to give you maps of your district of all the payday and auto title lenders registered as CSOs. And this data was taken from the Secretary of State, I believe, about a year ago now. We decided to be important for folks to know how many are in their district. And we have a map for each one of your districts that I'm sending you. And congratulations, Representative Nash. You have the most of the committee, 38. And Representative Truitt, Dan Sutherland in your office was convinced there were none in your district. However, there were 9. There were 9. And so not only did I show them the map, I printed out the company's websites pointing folks to their locations there. So for a grand total of the entire committee, we have 222 CSO locations. And for Representatives Craddock, Farias, Rodriguez, and Johnson, it's an even 100 that are in their districts combined. So, I think there's something, we talked about the clustering, and to me that shows not only that, of course, they're going to locate in lower income communities, but they essentially feed off each other in a way that's not in a traditional market sense. That if you default in one, you'll go somewhere else. Yes,
Hold on a second. How many did she say she had?
She's got 38.
All right. Okay.
You only got 31 or something like that?
Yeah, I thought I was number one, but
32.
I was going to get offended.
So the big winner in the House, by the way, is Representative Hochberg with, I believe, 47. The average is 21. And I showed this to one of Representative Hochberg's staff members back in the summer, and the first thing he said was, we have the smallest geographical district in the state. The smallest geographical district, the most densely populated, has more than anywhere else, which is interesting.
Representative Anderson?
Yes, I wonder if there's been any comparison to McDonald's and Wendy's in that same district.
That would be interesting. Obviously, we've heard statistics before that people have used that there are more payday lenders in the state than McDonald's and Whataburgers combined.
Yeah, typically it's a good thing to have lots of businesses in a district.
You'd think so. But I think it goes back to this situation that it's not a pure market. That, in fact, when you default on one, you go to another. And so it kind of feeds off of each other, and there doesn't seem to be that competition on fees, to drive down the fees. The fees all seem to be pretty consistent, and then when someone defaults, they just go to these other locations. And so I think the competition in this market, from my understanding, obviously I'm not in it, I don't have the data that they have, is not about who has the lowest fees, but who can be there first and fastest, and with some aggressive marketing. And so to put locations wherever you can put them, to make sure that you're the one they go to first is most important. And then secondly, it's okay to be around other ones because they're going to come to you when they default on the others. So that's my take on the situation there. And with that, I thank you for your time and sincerely for listening to all this testimony. I know it's a long day, but I think we understand the problem. So appreciate it.
We thank you for hanging with us, and thank you very much for all the effort and thoughtful consideration that you're putting into all this. We appreciate it.
Thank you, ma'am. Appreciate it.